Hi friends, this is Kishore. Welcome back to my channel. Today I am going to share some of the market internals to understand the market sentiment and market breadth. Earlier days, market looks like a maze to me. There are so many parts interconnected like bonds, gold, interest rates, yield, crude oil, and money moves one to another asset. And I feel like I got stuck and caught. Later, I understand I need to stand outside, understand the relationship between different assets first, so that I can choose the right path. Let's jump into the show. Last week, Goldman Sachs raises the S&P 500 price target to 4,500. So this news came last week in Wall Street Journal. And also, I read another news. Morgan Stanley cut the S&P 500 price target by end of this year due to bad profits. So which one I need to trust? Like, do I need to go with the Morgan Stanley or do I need to go with the Wall Street Goldman Sachs? So instead of that, I started looking into the market internals. So the first one I looked into is fear and greed. So this one shows extreme greed. So whenever I see greed or extreme greed, I recall Warren Buffett saying, "Whenever market is greedy, be fearful." And this is S&P 500 number of stocks above their 20-day moving average. So right now, last week I shared this chart. Whenever it hit 86, market reversed in the past. So similarly today, market reversed, but we will know it will reverse more or will it go up soon. And this is put call ratio. Whenever the put call ratio 10-day moving average went below zero point 0.8, market made a swing high. So now right now it is at 0.77. So let's see, market made a top and goes back to the little lower or will it go up further up? And this Nasdaq advanced decline line. So in the top it shows like Nasdaq advanced decline line, and the below you can see the Nasdaq. So whenever there's a divergence between the advanced decline line price and Nasdaq index price, we saw a big correction in the Nasdaq. So right now I'm seeing the same. Nasdaq price went up, index price went up, advanced decline line came down, and RSA also I can see going down, negative divergence. So I'm expecting some pullback in the Nasdaq by looking at this chart. This one is high yield and Nasdaq index. So the orange one is Nasdaq and the candle bar said high yield bond. So whenever there is a divergence in this, Nasdaq follows the high yield bond. In the past, when Nasdaq is going up and high yields are going down, later Nasdaq followed the high yield bond trend. Right now, I see huge divergence between the Nasdaq price is going up and high yield bonds are going down. So I'm expecting Nasdaq will follow the high yield bond trend soon. And this one is gold chart. So in 2008, S&P 500 made a big correction till 2009 March, and gold went up from 800 to the 1500, and it was there. Gold was there for certain almost a year to 2 years in the trend, and gold started falling back from 1500 to the 1000 later days. But if I see when it happened when market in the market the S&P 500 crossed the 0.786 Fibonacci level of the high to the low, and that means market see there is no risk in the stock market, so the money moved from the gold to the stock market. That's what I understand by looking at this chart. So this is the current gold and S&P 500. So right now the gold also consolidating between 1600 to the 1900, and S&P 500 when I draw a Fibonacci 11 from high to low like 4771 to the 3574, S&P 500 is just above 0.618 level and below 0.786 level. So if S&P 500 breaks the 0.786 level, will gold pull down to the again to some 1200 or 1300? Let's see. And this article came on 2020 August. The summary of the article is bubbles are created when interest rates are very low, and bubbles are burst when after 24 months of first rate hike. And Fed raised continuously 15 months, and this month, this is 16th month, and they paused the interest rate. And this is the Fed fund rates chart. So you can see Fed fund rates are nearly zero from 2009 to 2016, and again from pandemic 2020 to the 2021. And this is also another article released in August 2020 by same author saying that is there a bubble in financial market? The summary of the article is whenever there is a inversion yield curve means when the yield curve goes zero, the 10-year, 3 month or 10-year, 2-year yield curves, there will be big trouble to the financial market. So the right now the 10-year, 3 month yield curve is minus 1.53, and it never ever happened this low in the past of this 10-year, 3 month yield curve. And this one is 10-year 2-year yield curve and also 10-year 3 month yield curve. So right now both are under inverted means both are negative, and they are negative such a quite long time. It never ever in the history that such a long time is are inverted. So this one is very interesting. I shared the same chart in my last video. Whenever Goldman Sachs increased the price target of S&P, S&P made a lower low or low, and whenever Goldman Sachs uh, reduced the price target of the S&P, S&P went up. So by looking at the market internals instead of the media, I can come to some conclusion that market is right now need to be little cautious to go upside because the market breadth or market sentiment is not good to the upside. So and also I'm not saying the market will be corrected like 20% or 30%, but I'm not seeing any major upside in the Nasdaq or S&P. Thank you so much for watching. If you like this video, please like, share, and subscribe. If you like the video, please hit the like button. Please share the video if any of your friends looking for similar content. Watch more videos in my channel, and if you like them, please subscribe. Hit the bell icon so that you get notification when I upload the video. Thanks so much. Bye bye.